Periodically, I feel like I'm perpetually talking about inventory. Again, I remind you, I do not charge extra for the accounting humor. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that is my sidekick, Mr. Terrence T-Rex. And we're here to put the fun in accounting fundamentals. So in this video, we are going to compare and contrast the two inventory methods, perpetual inventory and periodic inventory. Now, if you've watched the whole inventory playlist, we've already touched on this before, and I said we would go more in depth. Well, this is the more in-depth version of perpetual versus periodic inventory. So let's take a high view of those two different inventory methods. So under perpetual inventory, we are constantly keeping track of how much inventory we have, how much inventory we have sold. So you can think of this as the Home Depot method or the Lowe's method or the Amazon method. They know absolutely everything that has come through their warehouse into the warehouse, been shipped out to the stores, and then we know exactly what's on the store shelves because everything is tracked every single step of the way. And we know what the cost was for those items because computers. And we know what we've sold. We know how many have walked out the door with a cash register receipt attached. So that's perpetual inventory. We know every step of the way what we have for inventory. Now, of course, it's not always accurate because things can happen. There can be paperwork errors. Something can come into the warehouse that doesn't get scanned in, or something can come into the warehouse and get lost amidst all of the other stuff in the warehouse. And we could also have situations where things get broken or things are sent as a full case, but there's two missing from it. And we don't know that when it comes in into the warehouse. And we also may not know everything that leaves the store if somebody shoplifts or if a package got broken open. We may not have completely accurate inventory figures, but we've got a pretty good idea. And then the way that we prove out our inventory numbers is that we have a regular periodic inventory where we go through and we count everything in the store, everything in the warehouse. And you've seen, I'm sure, going into various stores when they're having inventory, there'll be inventory tags all over the place because an inventory company has come in and done all of the counting for the store. So that's perpetual inventory. Now, on the accounting side, under perpetual inventory, what we're doing is we're recording both the sale of that merchandise and we're recording the cost of that merchandise. So let's take a look at the journal entries that go along with perpetual inventory. These may look familiar to you if you've seen other videos in this merchandising playlist. So every time we have a sale, we're going to have two parts to that journal entry. There's going to be the sale side, and then there's going to be the merchandise side. So we're going to debit accounts receivable or cash, depending on how our customer is paying, and we're going to credit sales. And that's going to record the sale of this little Terrence Stuffy right here. Now also, this cost under perpetual inventory, this cost is sitting in our merchandise inventory account because when we purchase things, it all goes into merchandise inventory. When we buy this, we are going to debit our merchandise inventory. We're going to credit accounts payable or cash. So once we sell this particular little guy right here, there he goes. He's going out the door. Bye. Then we need to take this out of our inventory. And we do that by crediting our inventory account. And we want to move that cost now into cost of merchandise sold or cost of goods sold. Because of what? The matching principle. That's right, Terrence. So that's the way we handle things under perpetual inventory. Now, for the purposes of accounting class, we're doing it, that hokey old kind of way. But in the real world, we would be using computers to track this inventory all the way through. And we would be using things like barcodes and barcode scanners in order to track everything. And then doubling back with the accounting paperwork, the invoices, etc., that are going to make sure that everything ties out the way that it should. Now, under periodic inventory, we're only keeping track of the sale when it happens. So we want to know what's going out through the cash register. And we're not going to know what the cost of our merchandise is until the end of the accounting period, usually the month. And under perpetual inventory, when we bought merchandise, when we bought our little Terrence stuffies, we said that that went into a merchandise inventory account. Well, under periodic inventory, we have a new account, and it's called purchases. Rather than going directly into an inventory account, we're going to hold all of our purchases in an account called purchases. And then later on, we're going to move them out of that account. But for right now, under periodic inventory, when we purchase something, it goes as a debit to purchases and a credit to accounts payable or cash. And we're going to dump all of our purchases into that purchases account. That's step one. In step two, we're going to get to the end of our accounting period, and then we're going to go take a physical inventory count to get our ending inventory amount. So we're going to go out to our shelves and we're going to count everything. I'm talking everything. I'm talking every little Terrence stuffy, every big Terrence stuffy, all the different flavors of dinosaur shampoo, all of the little Terrence treats, everything. And that's how we're going to come up with our cost. You can already see that this might be kind of a pain in the neck way of doing this. And you would be 100% right. Once we have our physical inventory count, now we need to do an entry to move out of purchases by crediting purchases, the account, and we're going to move it into our inventory account. So we're going to debit our inventory account, whether it's called inventory, merchandise inventory, whatever. We're moving it out of purchases and into inventory. And as you can continue to see, this is kind of a pain in the neck way to do things. Now let's take a high view for a moment of what it is we're about to do next, okay? So here's the way that we do our inventory calculation under periodic inventory. We have our beginning inventory. We add to that our purchases, which are all going into that purchases holding account. We add those two together and it gives us the goods available for sale. This is what we can actually sell. This is what we physically have in the building that we can sell. And then when we go do our physical inventory account, we're going to know what our ending inventory number is. And then we're going to take the goods available for sale minus our ending inventory, and that's going to give us our cost of merchandise or cost of goods sold. Are you continuing to feel like this is a pain in the neck way of doing things? You're with me on that, right? It's not just me. Okay. So once we know what that missing number is, once we've solved for X using the algebra that you didn't think you would ever use in life, here we are. Now we're going to do a journal entry to move this merchandise out of merchandise inventory, where we just moved it from purchases, and into our cost of merchandise sold. So we're going to do that journal entry, cost of merchandise sold and merchandise inventory. We bought the stuff. It came into our purchases account. The end of the accounting period, we moved it out of purchases and into our inventory account. We found out what our ending inventory was by doing a physical inventory count. And then we figured out the difference between what we had for sale and what was left and assumed that everything in between is what we sold. Got it? Great. So just a note about perpetual versus periodic inventory. Why would anybody do periodic inventory? Why would anybody do periodic inventory when you can now do perpetual? And it would be really only very small businesses that would use periodic inventory for the most part. If you've got an Etsy shop or something like that, maybe you would be doing periodic inventory because you can open your closet and go, I've got 6 of those and 12 of those. But for the most part, businesses would be using perpetual inventory. And it used to be very, very expensive to set up these perpetual inventory systems because you would have to buy a lot of equipment, etc. But for most small businesses, it's now very, very inexpensive to do this. I did it for a nonprofit gift shop where we were able to get them completely set up with barcodes and scanning and the equipment that they needed for less than $1,000. I think it was quite a bit less than $1,000. So it's now much more economically feasible for small businesses to set themselves up with perpetual inventory systems and not have to go through all of this craziness. But the biggest downside of periodic inventory isn't the annoyingness of it. There's an even more of a downside to it, and that is that you are not getting up-to-date information. So under perpetual inventory, you always know what your cost of merchandise sold is, so that you can look at your sales minus your cost of merchandise sold, know what your gross profit is, know what you have to spend on the rest of your expenses, and know what your profit is at any moment in time. Under periodic, you have to wait until you do that inventory. And if you're not doing it monthly like you should be, or you're just kind of, I'll get to it eventually kind of approach, you're never going to know how your business is doing. You're never going to know whether you're making a profit. And that's the biggest downside of periodic inventory, besides just the annoyingness. So there you have it. Perpetual inventory versus periodic inventory. Until next time, stay balanced, my friends.